How to put together a growth fund portfolio. Your current portfolio could be unstructured with no overall objective, lots of overlapping funds and uneven performance. After watching this video, it could move towards being very structured with a core holding of global funds and then some satellite holdings around that, looking at maybe different themes, sectors or factors. Core holding would be something like iShares Core MSCI World ETF, and we've got some pretty solid performance. And if you compare the performance of the ETF itself, which is the green, with the benchmark it's trying to track, which is the yellow, you can see that actually the ETF outperforms its benchmark, even though it charges 0.2% fee every year. And the reason for this is that it lends shares to short sellers and then makes a profit on that. So actually it has a positive tracking difference, and that's why this is my favorite global ETF. It produces better performance even though its fees are slightly above average, and the ticker is SWDA. So we've got our developed world tracker, and now we've got to consider whether we want to add emerging markets and small caps to that. And at the moment, I would just use simple momentum criteria as to whether or not I would want to add those. And for emerging markets, we've had trouble with Russia and we've had a recession in China, so I'm not so keen on those, although I think contrarian investors might be about to see a turnaround in that market and they might look to potentially now add emerging markets to their investment portfolio. Here we have a chart comparing a global tracker in orange with global small caps in blue, and the small caps have underperformed even though they are potentially more volatile. And I think the market has changed somewhat in recent years, where we've really seen some mega caps completely dominate the returns available, and that might continue on into the near future. So as things like Tesla was never a small cap and Google was never a small cap, I'm less inclined to add this potentially more risky area of the market into my portfolio. This chart compares a favorite of mine, the L&G Global 100, with our global tracker and also an all-world tracker that includes emerging markets. And there's a pretty resounding beat from the Global 100. And the reason for this is that the 100 largest companies in the world are fairly diversified in terms of their product offerings and the geographies they serve. The L&G Global 100 is much more concentrated in terms of its top 10 holdings than a standard tracker. However, I do feel that this concentration risk is compensated for by the price return, and I think that over the longer term, holding the top 100 companies will be beneficial, although we could see substantial volatility along the way. So when it comes to active funds versus passive funds in the global space, about 90% of active funds underperform. And the reason for this is that they tend to underweight the largest companies in the global stock market, because otherwise they'll just get accused of being a closet tracker. And because of the dominant performance of these mega cap companies, that's why active funds have underperformed. And if it had been round the other way, then we would have seen a lot more stellar active funds over the last few years. So it's not necessarily that fund managers are incompetent, it's just that the nature of how they do their selection means that when the very largest companies do well, they're probably going to underperform. But when you do find an active fund that does absolutely smash it against its comparatives, then you should certainly look at researching it further, like we did with the Royal London Global Equity Select. When considering funds for your satellite holdings, you might want to look at different factors. This can include value, minimum volatility, dividends. One of my favorite factors is quality, where you're looking for strength of the balance sheet and good operating margins. Now, unfortunately, some quality factor funds have sector neutrality, which means that they have the same percentage in a sector like healthcare as a global tracker, and that undermines their performance. One ETF where this isn't the case is UC99, which is a US Quality Factor ETF, and it does beat the S&P 500, although the degree of outperformance isn't maybe as strong as some of the other funds that I've shown you. So factors act as a filter to remove what you think might underperform from the underlying index. So the UBS US Quality ETF UC99 looks for a high return on equity, low levels of debt, and low year-on-year earnings variability. It then removes 400 companies from the S&P 500 that rank low on those criteria. And if you think, yeah, that's quite a good filter to put the holdings through, then it might be worthwhile considering. And the fee of that ETF is 0.25%, which is maybe 5 times what you'd pay for a standard S&P 500 tracker. So one interesting factor is momentum, where you basically buy whichever companies are going up the most, and it selects 348 out of the 1500 in the accompanying global index. When we come to the top 10 holdings, not surprisingly, Nvidia is number one, and then a high weighting to information technology. Now, you would think that this is a great ETF to buy, but the problem is that it only rebalances every 6 months. So if Nvidia issues a profit warning or some bad quarterly results, it could take a long time for this ETF to sell out. And so although you can have periods of outperformance, you can also have periods of underperformance. So I think it's actually quite a risky ETF to hold in your portfolio. For any growth portfolio, the NASDAQ 100 is an important consideration. One issue for you might be that the shares are just too expensive in terms of the PE ratio, which arguably is quite high. So you can maybe monitor that and see if it takes a dip, then you might be interested in investing in the NASDAQ. And if you pull up the iShares fact sheets, they always have the PE ratio. So they're my favorite fact sheets to look at. And then here we've got the top holdings of the NASDAQ, which is quite concentrated in terms of the top 10, and over 50% is information technology. One thing to consider is just how many holdings do you need within your ideal exchange traded fund. FTSE All World has over 3,600, MSCI Developed World 1,500, S&P is 500 when it was devised in 1957, and then things like NASDAQ, L&G Global 100 are even less. And I would argue that the more holdings you add to it, the more you're getting these also ran companies that aren't quite as great in terms of market dominance, in terms of R&D or branding, and that really you don't want to diversify too much in terms of the number of holdings in your fund. So looking through the top 10s of the ETFs that I've highlighted, you'll notice there is quite a lot of correlation, and what we can do is pull the price data into a spreadsheet and then run a correlation matrix on it. And what you'll see is that a global tracker is 90% correlated with the NASDAQ 100, which is pretty high. If you want to get a bit more diversified, you could do things like US healthcare or the Euro Stoxx 50, which has a correlation of only 0.6. So unfortunately, a lot of them are just variations on a theme, where it's almost like the NASDAQ is a global growth ETF rather than a more US focused proposition. So here's a potential way to structure your portfolio. For the short time period holdings where you need access to the funds within 36 months, you might want to hold things in the money market or short-term government bonds so that you've got your capital certainty and you're not worried about day-to-day movements in the stock market. In more medium-term holdings, you want some margin of safety, which I think you will get from a global tracker and from maybe the quality factor that we've already touched upon. And then for your longer term holdings, some of which you may never touch, some of which you might access in 20 or more years' time, then you can start to look at sectors like healthcare or themes like artificial intelligence. You could look at maybe individual countries or regions like Asia Pacific. For Europe, you might have heard of the Granolas, which are 11 leading companies, all large cap, that might show decent performance in the next few years because they have market dominance and huge R&D budgets. So there's certainly some growth potential there. So for Europe, I think the Euro Stoxx 50 is quite an interesting index because it's quite concentrated. It's got a lot of these large cap market leaders, and I would look to analyze that first because it has lower fees before I started to look at potentially active funds like this BlackRock Greater Europe Investment Trust that I can compare it to. And if the performance of the active fund is only slightly better, then I'd probably reject it because I do have this fund manager risk that I don't really know going forwards what the fund manager is going to buy, what they're going to sell, and how the performance will go. So over 1 year, yeah, there's a slight beat, but if you look at over 3 years, the active fund has been not so great. So I think initially stick with my trackers, and then I'd look at the sort of exposures that I'd want, the sort of rationale behind the active fund, and only if that appealed would I then start to look at investing in an active fund over a passive. This is a file that I use to help identify sectors and countries and factors that I might be interested in investing in. And it looks at returns, and then it also looks at the number of months a fund has spent lower than its all-time high and the degree of decline from that all-time high. And the number one is US healthcare over the last 7 years, where it's got a decent return and then it has actually been fairly stable in its pricing. And then the number two is a fund I've talked about a lot in the past, the Wisdom Tree Global Quality Dividend Growth. So I'm not just looking at straight price performance, I'm trying to get a blend between diversification, volatility, and price growth. Would I use a financial advisor? Well, the answer is no, because their fees are extortionate. There's no guarantee that they can beat any sort of benchmark, and also any advisor is only as independent as the funds that are available on the platform that they use. So a lot of financial advisors don't even invest in exchange traded funds or investment trusts. This is the portfolio of a certain financial journalist, and I just wonder, what is the objective of this portfolio? Is it growth? Is it income? Is it wealth preservation? It's kind of just a dog's dinner of all kinds of things. It's a complete mishmash. It can be really difficult to manage and take control of. And then when you're in retirement and you're looking to decumulate, to kind of spend some of this money, what are you going to sell? Are you going to sell the winners first? Or are you going to sell the losers first? It's just a really crazy way to go about things. You need a very simplified and well-structured portfolio that is robust across different market conditions. Be careful what you read in the financial press. I used to have a holding in a Vietnam fund. And I read things like how there was a low PE ratio of the companies, but this was in absolute terms and not in relative terms compared to other emerging or frontier markets. There were claims that Vietnam was going to move from being a frontier market to becoming an emerging market, and hence lots of trackers would have to buy it, but that turned out to be completely unfounded. There was talk of businesses relocating activity out of China and into Vietnam, but there's actually a very complicated relationship between China and Vietnam, and when China had a recession, that then stopped a lot of inward investment into Vietnam, and so Vietnam didn't do that well either. And the problem that I have is that I do have a lot of recency bias. If something's doing well in the short term, then I like it and I want to buy more of it, and I do end up buying high and sometimes selling low. I also think that if you have something like Vietnam, it can never be such a large percentage of your portfolio, so it's not really that great for a satellite holding. You'd have to have a lot of other holdings of this nature in your portfolio, and it would just make things very complicated. Thematic ETFs can be quite interesting, particularly if you have a real interest in the area that the theme is covering. However, often by the time you realize that a theme is performing quite well, it's already had most of the growth behind it, and you're just leaving yourself exposed to a potential bubble. So we've got some data on some themes here with semiconductors number 1, uranium number 2, metaverse, cybersecurity, artificial intelligence. It's all quite interesting, but I think you do need to be careful. It's probably less risky than buying just one company that seems to fit a theme, so maybe less risky than buying Nvidia on its own, but you do have to be quite careful if you're going to go down this route, and I'll send a link in the description as to how you can get hold of this file. The older you get, the more disciplined you need to be with your investing. Something like Scottish Mortgage might be a lot of fun when you're in your 30s, but if you're in your 50s, it's quite a scary ride. And when you actually look at some of the risk management that's going on and the position sizing that's going on, it's quite scary, and you're really not sure what sort of returns you're going to get. JPMorgan Global Growth and Income is an active fund where I feel that I do understand the objectives and rationale behind it, and I can explain why the performance is so great. And so that's why it's something that I'd look to have in a portfolio, but I wouldn't have too great a holding of it, just in case there was what's known as style drift, where the manager maybe changes or the outlook of the manager changes, and what was driving outperformance in the past then comes back to bite it. This video is part of a wider playlist entitled Investing Masterclass. Have a look at the other videos to get a broader picture on investing. If you look at the portfolio coaching section of my website, it expands more on some of the themes identified in this video. In terms of putting together an actual growth portfolio, I think it more comes down to your own personal tastes and preferences, because it's pretty much impossible to say that this market will grow over the next 20 years in excess of the US or Europe or whatever. So you just have to find your own areas of the market that you're interested in investing in. If you just want a global tracker, that might be okay for you, providing you have a risk-off asset like a money market fund. For guidance on picking funds, this is the video that I would recommend. Next up is an explanatory video on my free IT and ETF tracker that I use to keep tabs on major funds. just sign up to my newsletter and you can get hold of it.